Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is earnings. Right? We're in the middle of earnings season, so we're talking about earnings. Now, on a personal level, I went ahead and bought a pair of clippers and cut my own hair. Let that be a lesson to you. It's probably not the best idea. I just got fed up with the long hair and I had to do something about it. But didn't exactly turn out real well. Now, back to earnings. What do we have in earnings? So we're not going to look at earnings for individual companies. Again, we want to look at them at 30,000 feet, right? Earnings for the entire S&P 500. And not only the U.S. markets, we want to go abroad as well. So let's jump right into this. What we have here is the EBITDA, earnings before interest, taxes, and depreciation, for the S&P 500. And as you can see from this chart, we've just started to enter an earnings down cycle. An earnings down cycle. Now, I generally like to hold off for a month or two before showing this chart when it changes directions, because we do have revisions to earnings. And sometimes it looks like we rolled over and it's not real clear, right? You won't know it for a couple months. Now we clearly know. We are definitely in an earnings down cycle. So let's take a minute and talk about that. We got earnings down cycles and we have economic down cycles. Now the two often intertwine. I like to measure economic cycles by using leading indicators, right? The regular viewers will notice, will remember that I often like to look at changes in leading economic indicators. But the fact is, they generally coexist. They generally intertwine. If you're in an economic down cycle, which we are right now, you generally get an earnings down cycle. Now, the U.S. was the last to enter the earnings down cycle. Everybody else had already been there. All right, so, a bit of this coronavirus, it's a bit like talking about your exes. Right? Whether it's your ex-husband or ex-wife, they seem to get blamed for everything, right? Everything is bad in your life. But what we're going to see is the earnings down cycle outside of the U.S. actually happened months ago, sometimes over a year ago. So we can't keep blaming everything on the coronavirus. Signs of slowing were definitely apparent before we had the healthcare crisis. So let's go back to this chart. Again, for the U.S. markets, we've clearly rolled over, right? Entered this economic down cycle. Now, two observations from that. First of all, equities tend to underperform when you're in an earnings down cycle. They tend to underperform. All right, so let's chase that for a second. What you want to be thinking of in this environment is you want to be thinking about singles and doubles, right? Small hits. When you get a run-up, you take it. You pocket those gains, and you're happy with those. There are going to be very few, if any, home runs or grand slams. Those happen during these up cycles, right? During these tremendous up cycles. The down cycles, oftentimes you're lucky if you don't lose money, right? So again, adjust your risk profile. We'll talk about that a little more later. But you want to adjust your risk profile and also not be greedy. Not be greedy. Be happy with the singles and doubles. All right, so that's the first thing, the underperformance. We want to start thinking about that. We have to get this bull market mentality out of our head. Now we got to start thinking in bear market terms. All right, so we have the underperformance. Now the second thing is these down cycles tend to last for 1 to 2 years. 1 to 2 years. You can see this chart goes back to 98. And you can see the down cycles we've seen in the past. This was the energy recession in 2015. All right. It didn't end up being a recession, but it was still a down cycle. All right. So we've had a few very short-lived down cycles. But generally, if this is a true down cycle, which it clearly appears to be, we should be looking at 1 to 2 years in this bear market. Okay, so that's the U.S. Let's go next. We're going to move to emerging markets. EM. Same metric here, EBITDA. And again, based on the April observation, all these charts are April, a month-end numbers we're looking at. You can see this one continues to fall. But unlike the U.S., right, the U.S. just entered the down cycle. EM has been in the down cycle for months. Each one of these blue sticks here, folks, is a month. So you're probably talking, what, I don't know, the last year and a half maybe, that EM earnings have been declining. All right, now this is the area that concerns me the most, EM. You can see this box down here. We started with a healthcare crisis. It gave rise to a financial crisis, which gave rise to the oil crisis. And I believe next we're going to be looking at EM crisis. I'm very concerned about EM right now. All right, keep your eyes on that. That's a natural outgrowth of the oil crisis because many of these emerging market economies are commodity based. Okay, let's keep going. The last major market in the world then is EAFE, Europe, Asia, and the Far East. All right, it's largely European equities. Again, what's been going on here? We have this black dotted line that I use frequently in all my charts, in most of my charts, to show us the most recent observation. Clearly, we rolled over. We have rolled over months, if not a year plus ago, and we continue the downward trend. The downward trend. All right. So it doesn't matter where we look. The entire world now is in an earnings down cycle. And the entire world is in an economic down cycle. So what do we do with that? Well, again, if you like to adjust your portfolio over time, if you like to trade, think of singles and doubles. Be happy with them in bear markets. If you get a quick kill, grab it and go, right? Don't be greedy. If you have a longer term horizon, you don't want to be following the markets that closely. What you should be thinking about for the next year to 2 years is what they call moving up on the cap structure, moving up on the capitalization structure. That's a blue collar term. It means you want to lower your risk profile, right? So developed markets should beat emerging markets during this down cycle. Your higher quality balance sheets should do better than your poorer quality balance sheets. Your defensives should outperform, right? Your utilities, your staples, your real estate should outperform some of the other ones. In fixed income, well, first of all, fixed income most likely will outperform equities. But within fixed income, you also want to move longer out the term structure. You want longer duration. You want more convexity. All right, those are the things you want to think about. Those give you the hedges. Those are the defensive plays. And not only do they serve as hedges, but they can also serve as alpha generators to boost your returns. All right, so again, I want to lay out the entire spectrum here. We haven't talked about that for a while. Now we're clearly in this earnings down cycle. It's a good time to recap. I think we're in this long downward channel. And again, we're going to be here for a while. We're going to be here. And what we've seen so far are just tremors. Just tremors. We haven't seen the earthquake. Now that may scare the hell out of some of you, right? You say, what was March? What was that 25% pullback we had in March if that was an earthquake? Well, folks, I'm telling you, I think things are going to get worse than that. Just like they did in 2008. I have 4 landmarks in my head when I think about 2008. There was a firm called Sowood Capital in July of 2007 that started things off. And then we had Bear Stearns, like February, March of 2008. Then we had Freddie and Fannie toward the end of the summer. And then we had Merrill Lynch and Lehman Brothers at the end. Tremor, earthquake, right? It wasn't until Lehman came along that the earthquake happened. I think we got the same thing going on this time. What we've experienced so far is a tremor. The EM crisis that I think is most likely next step is going to be a tremor. Negative $40 oil, a tremor. All right. The big one, keep your eye on the big one now. I think the big one, the earthquake this time to worry about, is the corporate credit crisis. The large number of BBB rated U.S. companies that will be downgraded to junk status. They will lose their investment grade status and fall to junk grade. That is going to cause some huge chaos. Huge chaos. So again, as we go down this downward channel, and it's going to be a bumpy road, these choppy markets, you want to position your portfolio appropriately for the environment. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep.